review in 60 seconds or less. This is a high-level overview of a fairly advanced selling concept. You and your clients should only rely on tax and legal advice from an attorney, CPA, or other advisor. This review is for introductory purposes only. Today we are going to cover executive bonus in general, what they are, and where they fit in our advanced planning world. We will discuss how the typical executive bonus arrangement is structured when funding a life insurance policy. And finally, we will hit the high points that need to be considered when using or offering an executive bonus plan. So the question is, what is an executive bonus plan? First of all, it is a way for businesses to recruit, reward, and retain valuable employees while allowing the employer a current income tax deduction for participating in the plan. So from an employer's point of view, this is a recruiting and retention strategy that also allows a current income tax deduction for the participating employer. This is of a particular value for an employer who is structured and operating in a tax flow-through entity such as an S corporation or an LLC. Oftentimes, employers are willing to provide these types of benefits, but only if a current income tax deduction is available. As the footnote indicates, deductibility assumes that the employee's compensation is reasonable. These deductible employer funds are used specifically to pay premiums on a life insurance policy. We typically see cash value policies when dealing with executive bonus plans instead of term insurance because of the available benefits of permanent policies. Term insurance can only provide death benefit coverage for the employee, but cash value policies can also provide future cash value distributions for supplemental retirement income, plus there are additional new features such as chronic and long-term care riders. The typical executive bonus plan is structured to provide necessary death benefit coverage for the employee's working years and beyond, and/or cash value accumulation for supplemental retirement distributions from the policy's cash values. The vast majority of cases opt for structuring the policy to provide supplemental retirement cash flow potential by selecting the minimum death benefit allowed and funding premiums for the remaining working years. Newer lifetime policy benefits have become available and should also be considered when selecting the desired life insurance policy. These new benefits are either part of the base policy or added to the base policy as an additional rider and can provide benefits such as chronic care coverage, long-term care coverage, or guaranteed retirement distributions. Lastly, executive bonus plans can be discriminatory, meaning the employer does not need to provide similar benefits to all employees. This type of planning can benefit a few select employees that the employer feels should be singled out for special planning to, once again, recruit, reward, and retain. Here are the typical players when we consider executive bonus arrangements. We have the employer and the employee, of course, the life insurance company that will supply the selected life policy, the IRS, and our employee's selected beneficiary. First, the employer and employee enter into a written executive bonus agreement, and the employer transfers funds for the premium payment to the employee. The bonus amount will be added to the employee's W-2 or 1099, and the employee will need to pay income tax on the bonus received. The employer should be able to deduct the additional bonuses received by the employee as long as the employee's income is reasonable, which is almost always the case. The employee pays the necessary policy premium to the life company as originally planned. Alternatively, the employer can pay the premium directly to the life company. However, the employee's W-2 or 1099 will still reflect the additional bonus amount. As the policy owner, the employee has all the rights of ownership, including lifetime benefits such as cash value distributions and chronic or long-term care claims. and also has the ability to designate and change the selected policy beneficiary. Ultimately, the remaining death benefit will be paid to the designated beneficiary at the employee's death. Finally, let's cover some final important reminders for working with executive bonus plans. First, executive bonus is classified as an executive benefit plan in the business market. If your prospect is a business owner, then executive bonus should be considered when discussing available plans for employees, especially if the employer is a tax pass-through entity. Number two, the employee is the policy owner in an executive bonus arrangement. The employee's irrevocable trust can also be an owner if the planning has estate and asset protection objectives. 3. The employee is the insured, and in some cases the employee and his or her spouse can be joint insureds if the planning calls for a survivorship contract. 4. The employee is free to designate and change the policy beneficiary for death benefit proceeds at any time. 5. The bonus is taxable in the year of receipt for income tax purposes, and 6. It is also deductible for the employer, assuming compensation is reasonable. 7. The employer has no control over the policy, and once the premiums are paid, cannot forfeit them and get them back. If the planning purpose is a true handcuff, then number 8, the employer should consider one of the non-qualified plans such as True Deferral, 401k Lookalike, or SERP, where the employer owns the policy and can forfeit the benefit if the employee does not meet the specified requirements. Thank you for viewing this selling idea summary, and please send any comments to quicklifesales@gmail.com and check back frequently for new and updated content. Have a great day.